Hi, I'm Phil Grande of philsgang.com, nationally syndicated radio show, and Phil's Gang, where you can become a member of the gang, where every morning at 9:30 to 11 o'clock, I buy stocks and invest in stocks, and you can follow me live, just like you're doing now, and you can copycat me, and I also teach you how I buy stocks using charts. Okay, let's get started. On July 13th, I made a prediction, and I posted it. We had the similar chart that I thought the stock market would correct maybe 20-30% sometime in the last quarter of this year or the first quarter of 2013. I believe that more so now than ever as a result of what happened since we did QE3 on September 13th. And so all the other QEs, when Bernanke prints money and he depresses the bond yields to force all the big money, especially all the oil money that comes in this country and Chinese money, to not go into bonds, but to go into the stock market to artificially push the market up. It was the first time that I saw quantitative easing, where we started all the way here in November, where the market didn't keep running. We had one rally on that day on September 13th and never followed through. The market pulled back almost 4%, and we've been stuck there now for about 5 days. No matter how much they're printing and how much they're depressing the yields on the bonds, buyers have stopped coming in and buying these stocks that are way overpriced. The name of this presentation is going to be called Obama's Fool's Gold, Fool's Stock Market Rally, and Fool's Economy, Fake Economy. Let me explain. We all know the stock market crashed because of subprime mortgages, because the banks were holding these subprime mortgages, and when they tried to sell a $100,000 mortgage, they couldn't sell the mortgage, not even for $1,000. So what did that mean? That means they had to discount, they had to put on their balance sheet and discount the net worth of their bank by that same amount. So that's why the banks were collapsing, because subprime mortgages, the value, and you establish the value, it's called mark to market, meaning you establish the value of anything by what you can sell it for. If you want to sell your house today, if you paid $500,000, it's not worth $500,000, it's what you can get for it. And a lot of people in a $500,000 house are getting offers of $100,000 and $200,000. That's the real worth. It's the same thing for subprime mortgages. They were packaging and selling them, but there's nobody to sell to anymore. So here's what they decided to do. As the market was dropping from 13,000, heading on the way down, they came up with an idea. Bernanke and the boys and Paulson and Geithner said, here, why don't we do this? Let's force, especially the oil-producing money, all the oil money that comes into this country, and all the money from China that they get for all the goods they put on the shelves at Walmart, Target, and so forth. All these dollars that China gets for manufacturing all the goods that we don't produce, and for all the oil countries like Canada, Mexico, and South Korea, and they produce all the oil for us. So they got all these dollars. And what do they do with these dollars? They always take these dollars and they come in and they always invest in our bond and our stock market. They're about 40% of the investors. Now, the trick was to make sure they don't go in the bond market anymore. So here's the bond market over here, and then you have the stock market, and you have the stock market, and you have the stock market over here, and then you had all the investors coming in, like the Chinese and the Saudis and so forth. So Bernanke came up with a plan to force the money from these people, let that money shift out of bonds into the stock market over here. How is he going to do that? Well, what Bernanke did, he started a little printing machine over here in his basement, and there's a little lever, and he printed and printed, and he prints $55,000 every hour, 24 hours a day. And then what he does, he takes all that money, and what he does, he goes over and he buys these IOUs, he buys these notes, these treasuries, he buys these treasuries so that the yields on these treasuries will go down. So as the yields go down, and they get very unattractive, and so when the Chinese and the Koreans and everybody come in, they look and see the yields going down, and they're not attractive, so it forces them into the stock market. So that's what they did that's what QE is all about. to artificially move the money into the market. Stocks don't go up because of earnings or increased market share, or because the country where you have good savings and we have good productivity and good wages. That's what makes good stock markets. That's not why stock markets are going up. It's because they're pushing the money into the stock market away from bonds by printing all this money. And what's happening? They're killing the dollar. The dollar is getting killed, which is not good for these Chinese and all our producers. They don't like seeing the dollar go down, okay, because remember, they get dollars. So it failed, though. It wasn't working. So they had to change. They said, well, why is it? They're putting all the money in the market, but it's still coming down. Well, here was the problem. They got to change the balance sheets on these banks because the values of these banks were dropping as they couldn't find buyers for the mortgages. So they changed from mark to market to mark to model. They switched it so the banks, they changed the accounting rules so the banks could set their own values. Oh, my God. So a stock that was 100,000 went down to 1,000. They marked it back up to 100. That means everybody who was shorting the market had to stop shorting, and they instantly became buyers, and everybody was shorting the market. And didn't you know, wham, we went up 400% in a few weeks. And then with all the quantitative easing, with all the Chinese and the Koreans and everybody and oil Saudis putting money in the stock market, wow. So we had them they revalued all their subprime mortgages, and with revaluing their subprime mortgages, and with all the money coming in from around the world into the stock market instead of bonds, we had one hell of a rally going here. But the problem was it's a fake rally. It's not going up for the right reasons. Going up for quantitative easing. 80% rally we had on that. Now, once they stopped, they said, well, you know, the stimulus should be working. Well, guess what happened? They stopped, right? And it didn't work, okay? All of a sudden, what happened? The stock market collapsed, started to collapse again. Oh, my God. They said this stimulus isn't working. So Bernanke started to talk about it again, hinting again on QE3. So let's start talking about it, let's anticipate it, and they'll start buying stocks again. And sure enough, they did QE2. And again, what are they doing? The same thing. Bernanke keeps printing $55 million every hour on the hour to keep buying bonds to suppress the yields so that all the big guys won't buy bonds. They buy, all the money keeps pouring into the stock market. Sure enough, it went up again. But this time when it ended, we only had a 33% rally instead of an 80% rally. And sure enough, they said, well, hey, it should hold here. Now, and Obama said things are going good. The elitists, everything is just working, and the stimulus is working. Well, guess what? They stopped. When they ended QE, they ended the printing of money, they ended printing of the bonds, they ended up stopped depressing the value of the bonds, and what happened? The market started to collapse again. They panicked and they said, well, let's do QE, let's do QE3, but let's not do a QE3. Let's change the name because people are kind of catching on because we only had an 80% rally to good, but QE2 we only had 33%. So let's do QE3, but let's call it Operation Twist. And what we'll do is instead of printing money to buy bonds to suppress the yields, what we'll do is we'll raise money by selling other bonds, and we'll take that cash and we'll buy the bonds to suppress the yields so everybody goes into the stock market. And that's what happened. Bam, all of a sudden we go up, and sure enough, okay, we head up again, the same problem. We came back again. So think about this. So it pulled back every time they stopped QE. It would pull back. And then it started to pull back again right here. And then they had to extend it. They extended the twist. Now they started talking about another QE. And the anticipation of QE, everybody started to buy stocks again. And again, remember, Bernanke keeps printing $55 million every day. 55 million. Remember, we only pull out of the ground of gold 55 million he prints every hour. We only pull out of the ground every hour gold of $15 million, just to put in perspective. But now that there's a problem here, this is the first time we see that the market, guess what's happening? It went up one day on the 13th, 275 points, and stopped. Market pulled back about 3.7%, and for about it can't go back up. This is really unusual This never happened before. We had an 80% rally, 33%, 28%. Well, here's why. Here's what's going on. And this is why I think we're going to get this correction maybe even sooner than I thought. Maybe even we'll start when they start reporting earnings in the third quarter. Here's why. Remember, when a stock started out at $5, let's use that, and it went to $10. Well, remember, it went from $5 to $10. It went to $5 to $10 for the right reasons, because we had very good savings, we had good productivity, we had good wage increases, and companies were expanding their market share, and so a stock would go from $5 to $10 on those reasons. Well, guess what happened? The stock now goes up to, instead, to $50. Wow, it goes up to $50, but it's only going up to $50 not because of what makes the stock go up. It went up because they're doing this again. They keep on continuing to print all this money to make sure driving yields down in the bonds so the money goes into the stock market. So what they keep doing is pushing money into the stock market, into this stock right here. See? They keep pushing. So it keeps going up, but it's not really worth $50. But everybody was willing to buy it anyways, even though it's not worth $50. It's really only $10, because again, nobody cared about what a stock was valued, because now with QE, you just keep pushing the stock up. Who cares? As long as they keep printing money and keep pushing the stocks up, you want to be in on the action. Well, at some point, though, that stops, because what happens? Well, the company itself, let's use this color here for the company. The stock's $50 of this company right here, company A. That's his stock price, 50. But wait a minute, the problem, his sales are going down. So let's see, his stock price is going up because of all the money coming in. But guess what's happening? His company, the top line growth is going down. Let's say it was $1 million, and now it's $500,000. And now it's $200,000, and now they're only bringing in $100,000, but the stock is still $50. Why? Because again, Bernanke's printing money, and he's making sure he's buying all the bonds to depress the value, to make sure all the big guys are putting money in the stock market, forcing into the market, and they have nowhere else to put the money, and keeps pushing up the price of the stock. So, but now we're going into earnings season. They're going, wait a minute. What we're finding out right now is that these stocks, the top line growth is going down, but they came up with a trick. They said, well, how about if we keep telling the people, even though top line growth is going, they're beating expectations. Analysts' that should be good enough to hold it up, to fool them, and that's what they do. So how do they do that? Well, it's called earnings per share. If you have less shares, you have more earnings. So what companies do is a little trick. They go out and they buy a lot of their shares so they can move the earnings up, and that's how they beat the street. So that's what they're doing right now. Will they accept it in the third third quarter earnings? Now remember, these stock prices are up here, but the top line growth keeps going down. The income keeps going down. So people know that it's not. The big investors know it's at 50 when it really needs this needs really a 30% adjustment to where the real value is, because it's only this little scheme they're doing right here that keeps pushing money in because they can't go into bonds. So that's what we're going to have to wait and see. Now that little trick to beat analyst expectations, that's what has been keeping the stocks up, that little trick. Well, that's everybody knows about that little trick. Now, that was okay. Remember, back here, nobody really cared. Nobody really cared back here either. But now this is the fourth year, and we still haven't got any economy. There's no economy. We have no growth. Our GDP's dropped down to 1.3%, when all the other 11 recessions at the same time were at 7%. So now they're getting concerned. So I'm thinking that they're not going to continue to pay up $50 for a stock that's worth 30% less. Now, there's another problem, too, is that if they come out, if January, what happens is they do the fiscal cliff, and they turn around and they get rid of if they increase the amount of taxes from 15% to 43% on dividends, then that means you have to, if you're getting, instead of $8 dividend, you're getting $5. This means this stock has to have a 30% adjustment in price, too. So there's two reasons why these stocks are overpriced by 30%. So that's where the problem is. Now, there's one more problem. All this money that's being printed to be forcing into the stock market, okay, all this money is being printed to to buy bonds to drop the yields. So the Saudis and the Chinese and everybody who produce oil and goods for us, okay, with their dollars, to force them into the stock market. They're worried now. If gold keeps going up in price, which it is, gold's going up and up and up, and the dollar is going down and down and down, well, here's what they're going to say. Wait a minute, for all these goods and the oil and everything we sell you, we don't want dollars anymore. They're going down. We want gold. So here's what we're going to do. We want gold. We don't want your dollars anymore. My God, if they ever start selling dollars, it'd be over. But here's the worst thing. Forget them asking for gold. What if they say we want an increase in interest? And that's right. They're going to ask for either gold or an increase in, because they're taking more risk now as the dollar keeps getting devalued. They're going to say, hey, give us more interest. And remember, the only reason why the banks of this country have been surviving, remember, they're insolvent. Remember, this is the trick they played over here, mark to model. They're carrying the value of all these subprime mortgages, fake values, okay? Remember, they're still insolvent. This was just a little trick. So if they ask for more, if they either ask for gold or they ask for a raise in interest, if you raise interest rates on these banks 0.5%, they all file for bankruptcy. So we're facing a real problem here with this little scheme they got going. Many things can happen. Either we're going to get a 30% haircut in the stocks because the game is up. These guys aren't going to continue to overpay for the price. Or if we have the fiscal cliff and the dividends go up from 15 to 43%, we need a 30% haircut. And over here, we got a problem with the Chinese and the people who produce our oil and all our goods. They either want to get paid in gold as they keep devaluating the dollar every time we keep printing to force these people into the stock market. Think about it. They print all this money to force to buy bonds to get the yields to go down, to force all our oil producers and all the producer goods into the stock market. Well, now they're saying, hey, you're giving us dollars that are worthless. So they may either ask for interest, higher interest, or gold. In any case, you got all these headwinds right here that one of them is going to collapse this market. And that's my opinion. Join me at philsgang.com.